All right. My name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to put folks on to a strategy for real estate investors, something that I came across and I knew about it, but I was doing some research and the strategy came across and I was like, oh, this is pretty interesting. So I figured it's something that I would share to folks. This specifically deals with real estate investors, especially those that are in the rental property game. So for those that have your rental properties, as many of you, if you're in the game, you may already know that there's a limit on the amount of losses that you can take or show from your rental properties. To review very quickly, it's 25,000 a year that you can take in losses to offset your other income. So for example, if you have a job and you have your rentals, you can deduct up to $25,000 of loss on your rentals against your job income. Now, there are limitations with that. Essentially, if you make more than $150,000 in the course of the year, you can't take anything. And as you cross the $100,000 threshold and work your way up to the $150,000 threshold, that 25,000 gets smaller. So essentially that $25 gets reduced by dollars for every dollar that you're over 100,000 to 50,000. I think I'm saying that right. But nonetheless, it gets reduced. However, there are some exceptions to that. And that's the strategy that I wanted to talk about because I have a number of clients that are in that situation where they make pretty good money and they have rental properties. However, many of them will cross that 150K threshold. So they can't take the losses, at least not right away. You can't take those losses in this, by the way, you bank them. So they're not lost forever, but you can take them once you get out of the property. The issue with that is if your strategy is to hold the properties long term, if you're not getting out of that property, you won't really be able to utilize those losses anytime soon if you're a buy and hold type of investor. However, there are exceptions to this rule. And one of the ways around that, and if you qualify for this, you have no limit, you have no cap on what you can deduct. And the exception is what's called a real estate professional rule or exemption. It essentially states that if you are in the real estate business, or if you are deemed a real estate professional, then they deem that as your business and you're treating it as a regular business, you have no limitations on the deductions that you can take from your rental property. So you can use that to offset all sorts of other regular earned income. Now, there are hard and fast rules to qualify as a real estate professional. And to qualify as being a real estate professional, as far as the actual occupation, you can do a number of things in the industry of real estate. So it doesn't necessarily have to be, oh, I just manage rental properties. For example, if you are a realtor or real estate agent, that is a profession that counts as a real estate professional. If you are a property manager, that's another thing that's deemed as a real estate profession. There are a number of different things that you can do associated with the industry, but that aren't necessarily tied to being a property owner, so to speak. So I wanted to at least identify that as far as what the real estate professional professions may be. Things, say, an appraiser. There are a number of different things that you can do within the real estate industry to qualify as a real estate professional. That's the actual job part. Now, there are requirements as far as your income and your time. First one being the income, 50% or more of your income needs to be generated from a real estate profession activity. So if you have a job that's not associated with real estate, your income needs to be higher. A majority of your income needs to come from outside of what you would make at your job. So there's the 50% rule. And then the other is the 750-hour rule, where that person must spend 750 hours or more per year doing that particular real estate activity. So if you are a realtor, and if that's all you do, very easy to hit that mark. If you are just doing property management, very easy to hit that mark. The idea here is they want to make sure that you're spending most of your time and earning most of your money within the real estate profession. Those are the two pretty much hard and fast rules that you do need to follow to make sure that you qualify for it. I went through how that works to lay out a potential play that one can do. Now, it is very specific to folks' situations. So not everyone is necessarily going to qualify for this. This is essentially for folks that are married who have spouses that do not earn an income. This could be a nice play for you. What you can do is that spouse that is not earning an income, they can qualify as the real estate professional. And the idea behind that is if you file a joint tax return with your spouse, then as long as one of you qualifies as a real estate professional, you would both qualify. As long as one of you qualifies as a real estate professional, then you can both enjoy the benefits of taking those deductions as a real estate professional. If we want to take an example here, as far as let's say that you have one spouse who's the breadwinner, they go out, they work, and they also have these rental properties as well. And then you have the other spouse who is stay at home. They don't really earn any income. Or, and I've had a client in this particular situation where they are looking to work or do things and they're not earning much of an income. And so that way, if you have a spouse that is not earning the income, that they are focused on managing said properties, and that is their job, so to speak, then they could qualify as a real estate professional. And with that, offset some of that other earned income that the other spouse may be earning. It's a good way to really be able to use up those losses from your property, because with most folks that hop into rental real estate, the advantage is to have a cash flowing property, but you essentially don't really pay taxes on that income from that cash flow, mainly because of depreciation. And so it winds up being tax-free cash flow while also building equity. So that's usually the advantages of doing the rentals. This way you get that extra tax benefit of really being able to use that depreciation to offset your other income. Again, very specific to married couples when one spouse is not earning anything. That could be a nice play if you open up a number of losses and open up a world of deductions and can hopefully save on your tax bill. So that's all for now. I hope this helped. So if you have any more questions about this topic or any other tax or accounting related questions, feel free to reach out. I'm happy to help. All right. That's all for now. And I'll talk to you in the next one.